If you've been scrolling through your brokerage app this month, you might have noticed a new ticker sitting next to the familiar IVV. I'm talking about Vanguard's brand new S&P 500 ETF, the V500, which officially started trading on the ASX on March 4, 2026. Now, there's been a lot of buzz about this launch. Some headlines make it sound like Vanguard just invented a way for Australians to invest in America. But let's be clear, we've had access to the S&P 500 for years. So what actually changed? In this video, we're going to do a deep dive into the V500. We'll cover exactly what it is, how it compares to the incumbent champion, iShares IVV, the difference between the hedged and unhedged versions, and most importantly, whether you should actually buy it in 2026. Let's get into it. What actually changed? The 3 routes to U.S. stocks. To understand why the V500 matters, we need to quickly recap how Australians have historically invested in U.S. stocks. There have always been 3 main routes. First, there's the direct offshore route. This is for the experienced investors. You open an account with an international broker like Interactive Brokers, convert your Australian dollars to US dollars, fill out the W-8BEN tax forms, and buy US-listed ETFs directly on the NYSE or NASDAQ. It's flexible, but it's a hassle for the average investor. Second, there's the ASX cross-listed route. This is where funds like Vanguard's VTS come in. You buy them on the ASX, which is convenient, but the underlying fund is still foreign domiciled. There's still some cross-border complexity with tax and reporting. Third, there's the Australian domiciled ASX ETF route. This is the simplest model. The ETF is structured in Australia, traded on the ASX, and handles all the tax and reporting for you. Before March 2026, the dominant player here for S&P 500 exposure was iShares IVV. So what changed? Vanguard didn't open up a new market. What they did was launch a new Australian-domiciled S&P 500 ETF range, making the local wrapper route more competitive, more visible, and simpler for mainstream investors. It's not a regulatory revolution, but it is a major competitive shift in the Australian ETF landscape. The spec sheet, V500 versus IVV. Now let's put these two heavyweights side by side. On one side, we have the new contender, Vanguard V500, unhedged, and V5AH, hedged. On the other, the reigning champion, iShares IVV, unhedged, and IHVV, hedged. Let's look at the numbers that matter most. The management fee. This is usually the first thing investors look at. iShares IVV charges a management fee of 0.04% per annum. On a $10,000 investment, that's about $4 a year. Vanguard V500 charges a management fee of 0.07% per annum. On a $10,000 investment, that's about $7 a year. So IVV is technically cheaper. It's a 0.03% difference. On a $100,000 portfolio, that's a $30 a year difference. It's not nothing, but for most investors, it's pretty negligible. However, if you're a pure fee maximizer, IVV wins this round. The hedged version fees. If you're looking to eliminate currency risk, the fees are slightly different. iShares IHVV also charges 0.04%. Vanguard V5AH charges 0.09% per annum. Here the gap is a bit wider at 0.05%, so for the hedged version, iShares has a more significant cost advantage. Fund size and liquidity. iShares IVV. This fund is a giant. It holds approximately $13 billion in assets under management on the ASX, making it the 3rd largest ETF in Australia. This means high liquidity and tight bid-ask spreads. Vanguard V500, this fund is brand new, launching in March 2026. Initially, liquidity will be lower, which might result in slightly wider spreads for large trades. Hedged versus unhedged, V500 versus V5AH. One of the biggest points of confusion for investors is the difference between V500 and V5AH. Vanguard launched both, giving you a choice, but which one is right for you? If you buy the unhedged V500, you're buying 2 things: the performance of the S&P 500 in US dollars and the AUD-USD exchange rate. If the Aussie dollar drops against the US dollar, your returns go up.
If the Aussie rallies, your returns get reduced. It's a double-edged sword. If you buy the hedged V5AH, the fund manager enters into currency contracts to neutralize that exchange rate movement. You get the pure equity return of the U.S. market translated back into Australian dollars. This is useful if you want U.S. equity exposure without taking a view on the Australian dollar. Which one should you choose? Hedged V5AH is often considered when the AUD is historically low, or if you already have a lot of unhedged global assets and want to balance your currency exposure. Unhedged V500 is popular for long-term investors who believe the USD will remain strong, or who want the diversification of having assets in another currency. Remember, hedging isn't free. The cost is built into the fund, which is why you see a higher management fee for the hedged version. Neither version is inherently superior. It depends on your personal investment strategy and risk tolerance. What about V500 versus NDQ? I've seen some comparisons floating around asking V500 versus NDQ, but this is really an apples to oranges comparison. Let's clear this up. The V500 tracks the S&P 500, which covers the 500 largest U.S. companies across all sectors: technology, healthcare, financials, consumer goods, you name it. It's the benchmark for the entire U.S. stock market. The NDQ from iShares tracks the NASDAQ 100, which is heavily concentrated in technology. It includes the big tech names like NVIDIA, Microsoft, and Apple, but it leaves out entire sectors like financials and consumer staples. The NDQ has a much higher management fee of 0.48% compared to V500's 0.07%. So if you're looking for broad, diversified exposure to the U.S. economy, V500 is the better choice. If you want a concentrated bet on the tech sector, then NDQ might be considered, but it's a different risk profile altogether. Vanguard's structural advantage. Now let's talk about something beyond the numbers. Vanguard is not like other fund managers. It operates on a unique client-owned structure. The company is owned by its funds, which are owned by its investors. This isn't just marketing fluff. It has real implications. This structure means Vanguard's interests are aligned with yours. They don't have external shareholders demanding profits. Instead, they can lower fees over time as their funds grow. This is the legacy of their founder, Jack Bogle, the pioneer of index investing. So what does this mean for the V500? While IVV is cheaper today, Vanguard has a long history of cutting fees as funds scale. As the V500 attracts more assets, and it likely will, there's a real possibility they will lower the fee in the future to become the cheapest option on the market. For long-term investors, this is a factor worth considering. The final verdict. Should you buy V500 in March 2026? So let's answer the million-dollar question. Is the V500 worth buying in March 2026? Here's my breakdown depending on your investor profile. Scenario 1. You are a new investor. You want simplicity. You have a ComSec, Stake, or Perler account, and you just want to buy a slice of America without opening a separate U.S. brokerage account. Recommendation: V500 is a great option. The 0.07% fee is still incredibly low. The brand is trusted, and the workflow is simple. You won't go wrong with it. Scenario 2. You are a fee-focused maximizer. If you have a large portfolio and you run the numbers on every basis point. Recommendation: stick with IVV. 0.04% is the lowest fee in the market right now. Until Vanguard cuts fees on the V500, IVV wins the pure cost battle. Scenario 3. You are a Vanguard fanatic or long-term optimist. If you believe in the Vanguard business model and you think they will eventually become the cheapest option. Recommendation: buy V500. By supporting the new entrant, you're increasing competition in the Australian market. As the fund grows, Vanguard has a strong history of passing those savings back to investors. Scenario 4. You want hedged exposure. If you're specifically looking to eliminate currency risk. Recommendation: go with iShares IHVV. With a fee of 0.04% compared to V5AH's 0.09%, iShares currently offers a significantly cheaper way to get hedged S&P 500 exposure. Conclusion: The launch of the V500 is a win for Australian investors. It validates that the Australian domiciled ETF market is maturing. We now have two heavyweight champions competing for our S&P 500 dollars. Don't get caught up in the hype of a new product. The underlying asset, the 500 largest U.S. companies, hasn't changed. What has changed is your choice to access it. Whether you choose Vanguard's new V500 or iShares' established IVV, the most important thing is that you stay invested, keep costs low, and stick to your strategy. If you found this deep dive helpful, please hit that like button. It really helps the channel.